Someone you know is beating you in the stock market right now. He set up an automatic transfer in 2013, forgot about it completely, and just found out he has $210,000. He watches football, drives a Chevy, has never thought about Fed policy for a single second of his adult life. And he's winning. His name is Greg. He teaches gym class in Columbus, Ohio. His 401k is invested in the default S&P 500 index fund his HR department selected on day one. $400 a month, automatic, same day, every month. He has never changed the allocation. He has never rebalanced. He set it up during onboarding and went back to his life. Last week, that account crossed $210,000. He found out from an app notification. He almost swiped it away. He thought it was a promotional email. Now meet Marcus. Marcus has 3 monitors. It is 6:47 in the morning. Nvidia is down 2.3% on some export restriction news, and Marcus is running the math in his head while his coffee goes cold. By 9:30 a.m., when the market opens, he's already been at this for 3 hours, already exhausted, already second-guessing the position he was confident about yesterday. Marcus has a watch list of 34 stocks. He knows the earnings date for most of them. He has opinions about Fed policy that are genuinely pretty well reasoned. His portfolio has underperformed Greg's for 11 years straight. Marcus's problem isn't knowledge. He actually knows a lot. The problem is that every piece of information he absorbs becomes a reason to do something. Sell here, rotate there. This looks overvalued. That's a buying opportunity. It feels like investing. It is closer to expensive fidgeting. The market is not impressed by how much research you did. It doesn't grade on effort. And if you're watching this with 17 browser tabs open, a stock screener running in the background, and a Robinhood notification you haven't checked yet, I'm not judging. I'm just saying, this video is specifically for you. Marcus is trying to beat the market. Greg doesn't know that's a competition. If effort actually made you money in markets, Marcus would be rich. Charles Schwab ran a study. 5 investors, same amount of money every year, 20 years, different strategies. One investor timed every single market bottom perfectly, bought at the absolute lowest point every year for 2 decades straight. Another investor put the money in on January 1st and went back to their life. The perfect market timer ended with $186,000. The January 1st investor ended with $175,000. The gap between flawless, never wrong, perfectly timed investing and just showing up once a year? $11,000 over 20 years. That is $1.50 a day, before taxes. Marcus is grinding for $1.50 a day, and the market hasn't told him yet. Fidelity once looked at which accounts performed best across their entire customer base. They expected the sharpest traders, the most disciplined researchers. The top 2 categories? People who forgot they had an account, and people who had died. Nobody got that memo to Marcus. Here's something most finance videos skip because it's a little uncomfortable to say. Most people can't be Greg. Not because they don't know the strategy, everyone knows index funds exist, but because watching your money sit still feels irresponsible. The market drops 8% and doing nothing feels like negligence. Every headline is a reason to act. Every red day feels like a personal failure. Marcus isn't irrational, he's just human. The same instinct that makes him a good employee, respond quickly, stay informed, don't let things slip, is the exact instinct that destroys his portfolio. Greg doesn't have that problem, not because he's disciplined, because he's indifferent. He genuinely does not care what the market does on any given Tuesday. That indifference, which looks like laziness, is actually the hardest thing to replicate in investing. Turns out the secret to winning is not caring whether you win. March 2020. The S&P 500 drops 34% in 33 days. Fastest crash in modern market history. Marcus sold. He called it protecting capital, the phrase people reach for when they want panic to sound like strategy. He'd buy back in once things stabilized. Greg didn't sell. Not because he had a system. He didn't sell because he wasn't watching. He was trying to find hand sanitizer and figure out if his school's Zoom situation was going to work. His $400 auto debit went through on April 1st exactly like it always did. He bought near the bottom of a generational crash, by accident, while distracted. By August, the market had fully recovered. Marcus bought back in at roughly 27% higher than where he sold. 2 years of careful analysis erased in 1 month of being scared. And if you think you just need to be roughly right, not perfect, just close, missing the bottom by 2 months means a simple monthly investment still beats you 97% of the time. That's not a typo. Most investors have had a version of Marcus's moment. I am most investors. I sold something once to protect myself and watched it recover without me while I constructed increasingly elaborate explanations for why I'd made the right call. You do eventually buy back in, at higher prices, telling yourself the situation is different now. And if that sentence just made your stomach drop a little, you already know exactly what I'm talking about. The situation is not different. Greg's $400 a month going into his 401k. Let's actually follow it. He starts in 2013. Year 1, he puts in $4,800. The market does its thing. He doesn't notice. Year 3, the onboarding checkbox kicks in. His contribution has quietly grown to $484 a month. He hasn't thought about it. HR did it. His direct deposit just got a little lighter, and he didn't ask why. Year 5, $585 a month. He has never logged in to check the balance. His wife asked him once if they had savings. He said, "Yeah, I think so." Year 7, $710 a month. The amount he's investing has nearly doubled since he started. 0 decisions made. Year 10, $940 a month. He is investing a mortgage payment every month and has absolutely no idea. Flat $400 a month, no step up, 10 years at historical returns. You end up around $82,000. With the 10% annual step up, the checkbox, studies put the final number roughly 45% higher. One checkbox, ticked in 2013, while thinking about something else. Financial advisors charge people to set this up. There are graphs, there is a meeting, there is an invoice. Nobody in that room gets paid to tell you the boring thing works. Greg's HR form told him for free. And if your own 401k has that auto-escalation checkbox sitting unticked right now, this is your sign. It takes 45 seconds. Future you will be embarrassingly grateful. $10,000 in the S&P 500. 1993 to 2023. 30 years. You end up with $182,000. Now, remove the 10 best trading days from those 30 years. 10 days out of nearly 7,500. You end up with $83,000. The best days in market history cluster right after the worst ones. The biggest recoveries came during 2008 and March 2020. The exact moments when every informed, paying attention investor was either sitting in cash or waiting for the situation to clarify. Clarity, incidentally, never actually arrives. You just eventually get tired of waiting and buy back in. I know this personally. I'd rather not say how personally. Marcus missed those days. He was being careful. Greg caught every single one. He wasn't watching. One thing worth saying before the last number. The last 15 years were unusually kind to anyone holding the index. Near zero interest rates, no major recessions, financial assets going up almost continuously. Greg got lucky with timing he didn't know he had. So when passive investing looks like a genius strategy right now, some of that is structure, and some of that is era. Professional fund managers, analyst teams, Bloomberg terminals, every incentive in the world to perform. Because if they underperform for 3 years running, they lose their clients, their fees, and eventually their jobs. That pressure doesn't sharpen them. It destroys them. It turns long-term problems into short-term panic. Over the 20-year period ending in 2024, 94% of actively managed large-cap funds underperformed the S&P 500. The index they all lost to has no manager, no opinions, no quarterly review, no job to protect. It just buys everything and holds it. It is, in temperament and structure, Greg. So what does Greg's setup actually look like? It's almost embarrassingly simple. His 401k auto-debits every month into the default S&P 500 index fund. Contributions go up 10% every year automatically. He has never picked a stock. He has never timed anything. He doesn't have a brokerage app with charts. He doesn't know what his expense ratio is. He also has $210,000 and a fishing boat he bought last spring. Greg doesn't know what dollar cost averaging is. He's been doing it for 11 years and learned the term last month when his nephew brought it up at Thanksgiving dinner. The nephew, by the way, trades options. He did not ask Greg how his portfolio was doing. Marcus knows exactly what dollar cost averaging is. He also knows about value averaging, tactical allocation, momentum factor investing, and at least 4 other strategies he's rotated through since 2013. Marcus spent thousands of hours trying to beat the market. He got close a few times, kept detailed notes. Feels like it should count for something. And look, if you've been Marcus in this story, that's not the end of it. Most of us start there. The market has a very specific way of punishing trying too hard, too often, with money you haven't secured yet. Knowing that is worth something. Greg didn't beat the market either. He just didn't lose to himself. Marcus is still optimizing his portfolio. Greg just bought a boat. This is Breaking Money. See you in the next one.